Hey, good morning, everyone. Marty Mazzora here. Midweek market snapshot on Wednesday, June 29th, 2022, 98 minutes after the open, to be exact. So recall that over the past couple of weeks, we've been calling for what could be a pretty special bear market rally in stocks. I even devoted a video roughly 2 weeks ago, titled it Bear Market Rally Prospects, and talked about sentiment and the technicals and positioning and so on. We've got that. Still not anything close to what I called back in here as an upside target of 4,300 on the S&P. This last Sunday when I updated you, I talked about these gaps and how that one was getting filled, and I pointed to this one as perhaps maybe a good upside level if this were to continue. So we're a day away from the end of the quarter. I talked a little bit last time about quarterly rebalancing. So when you have a month or a quarter where stocks have suffered relative to, say, bonds and cash, funds that automatically rebalance to a preset mix would be selling their fixed income positions, buying equities to get back to their target mix. And anymore, this seems to be just a real common thread, a real common conversation among market participants. And as I alluded to also last time, that you would expect, therefore, that for this to be getting somewhat of a front running as folks get in front of that. And so I think last week's rally, to no small degree, had something to do with that. Also pointed to what looked like quite a bit of short interest, both among hedge funds and among options dealers, that ultimately would get covered. So you can get some really substantial when you have those factors, plus really ugly sentiment, which continues to be the case, which I wrote about this morning in the written note. But we're getting to month end. Now, one other tidbit, Bespoke Investment Group, one of our research partners, wrote a piece this week talking about the fact that the next few weeks are actually among the best over the past 10 years for the market. I guess I didn't realize that, and I don't really sympathize with that at this point, given lots of factors, where the market is, where the Fed is, potential for earnings estimates to get sorely disappointed in the weeks and months to come, which would suggest that Wall Street will probably start ratcheting down those earnings estimates. That can be ugly for stocks and so forth. So I'm sitting here thinking, once we start moving into July, these other factors could very well overwhelm any potential buying pressures, and we could see the market begin to trend lower and stay in this whole bear market phase. So with regard to that seasonality, using a great tool that Bespoke provides, I actually went back and looked at the last 10 years, second half of June, right? The period immediately preceding those good few weeks that are to come, seasonally speaking. And what's interesting is that the average return over the last 10 years for the last half of June have actually been negative. So the setup going into July on average has been where stocks have sold off and then they bounce the first couple weeks, say, of July. Well, this year it's been the opposite of that. We've had a really good second half of the month for June, still a down month overall, but a good second half of the month. So the setup leading into early July doesn't really fit the seasonal patterns. So this may be the exception to the rule going forward. Now, again, this is short-term stuff, and I do think it's important for us to help clients gauge their short-term expectations and gain some understanding of some of these underlying factors that really have to do with positioning and short-term trading and so on, so you don't draw what we believe would be the wrong conclusions about the volatility and where it's coming from, which thus allows us to keep our long-term perspective and continue to find and exploit the opportunities inherent in every setup. In this one, we think it's unique and special in some regards when you have, say, a 5+ year outlook. It's just you got to get through the volatility along the way. Be very, very patient. Our job is to do our best to mitigate the downside, but again, to be in a position to fully exploit the upside in these areas that we're thinking about, and even some traditional areas when stocks get cheap. And we do think they get cheaper before this is all said and done. So let's just quickly run through two or three of the charts. This is that 60-minute chart that's been so good to us in terms of gauging short-term movements in the market. You recall this circle back here we made as the market was coming down to this area, and we just saw lots of reasons to think that would be the staging spot for the beginning of something special to the upside. And that was a really nice rally. Then it consolidated here and our momentum indicators rolled over, and it was pretty easy to say this looks like it's about to give up the ghost. But then we, over the next few days, again, this is each bar is an hour, we developed that bullish look again, falling wedge with bullish divergences, and we came out of that. And as I said here recently, this was as good a looking setup as we've seen, as we've been looking at this short-term chart. Well, in today's session, the market is just bouncing all over the place. You may recall when we were up in here and on our way back down, I flagged this as being really obvious support. I thought there'd be some strong buying here. Dead wrong on that one. Cut right through that, continued to go down, and then rather than being support, it's been resistance during this time, right? So what was once support tends to become resistance as we break through that. So we broke through it, came back, resisted it all the way through here and all these hourly bars. Then we gapped up above, and remember I said gaps tend to be filled. Well, they tend to be filled in both directions too, right? So we gapped up. So you could easily see us come down and fill that gap again. So I'm kind of pointing here again, at least in the very short term, and I mean really short term, as an area of potential support, and we'll see. It's about to test that. If it blows right through there again, then then we're going to start talking about our ultimate lower targets that we've shown on the weekly and monthly charts. So it wouldn't surprise me over the next day or two to perhaps get a bounce off of this. And that's what's been happening today. We've been coming down to it, bouncing off of it, and so forth. Right now, as I speak, we're right at 38.19. This is a delayed chart, by the way, but the live chart says 38.20 is where we are right now. And this line right here is at 3,800. So we'll see. It wouldn't surprise me to see today and tomorrow bounce off of that and get a pretty decent two-day rally. However, I'm skeptical as to the setup going into July. So to the extent that others en masse perhaps share that skepticism, then any rally today and tomorrow would be getting sold into, and as people position for potentially, a rough July. And again, this is all, short-term speculation. Doesn't really mean a lot to us in terms of how we're allocating on a long-term basis. It does affect the hedging. Right now, we've had to shorten up the time frame on our hedges. We've actually exploited this by buying some call options. That worked out really well. On Monday, we took profits on the last of our S&P 500 call options because we have this short-term thesis that people will sell once we start getting into July. So we didn't think probabilities favored that tactical move where we were essentially hedging our own put options. So we're not in that position today, but we could be, depending on how things shake out. So this one just isn't as obvious. You do have this consolidation. You can see you have some bearish divergence building right here. But again, could be pretty strong support, could be a bounce, and who knows? If Bespoke is correct, it bounces hard into the first half of July. I'm very open to that possibility. Right now, I'm a bit skeptical that that's how this will play out. So we'll stay on top of it, and I'll keep you up to date. The daily chart actually continues to look unbalanced constructive. This is actually a buy signal here, which validates this bullish divergence. We gapped up, we filled this gap. I talked about this gap as being a potential, if this gains momentum. Right now, it's not happening. We need to spring off of that in a big way to get the kind of momentum that would take us up here. And then as I read this, that 4,300 upside that I talked about looks less and less likely. Of course, some sort of macro news event could easily make that happen. But right here looks like really solid resistance, call it 4180. There's lots to play out, lots of potential sparks for a rally. Some of it would just be weaker economic data and the Fed just sounding a little bit dovish relative to how they've sounded of late. Could be a resolution to the Russia-Ukraine war, could be China really ramping up their stimulus, which is what they promised to do, which has been reflected quite notably in Chinese stocks of late. Could be a fiscal stimulus package announced, which I expect actually, by the US government. Now, despite the rhetoric and what they claim, it should be viewed as inflationary, virtually anything they come up with, at least initially. But if it shows up against continued rolling over of inflation, some of the things like I showed you in the first half of yesterday morning's note, then that could be something net positive for stocks. If the market tends to believe that inflation is nevertheless beginning to wane, and the Fed therefore is not going to be quite as aggressive. If you look at Fed funds futures, we're discounting about half as many, or 2/3 to half as many hikes as we were discounting, say, 3 weeks to a month ago. So the market's beginning to expect the Fed to back off, which means there's a lot of concern and pessimism over the state of the economy going forward. Mortgage rates have even backed off a little bit the last week or so. So folks, that, as usual, went longer than I expected. I'll show you the weekly and monthly charts next time, but there's nothing there that says that we should be optimistic in a sense that this market has already bottomed. That just doesn't seem to be in the cards from a variety of angles, and certainly technically speaking when we look at the weekly and monthly charts. However, I do expect this choppiness as we continue to work our way through what is, by definition, bear market conditions currently. I'll leave it there. Thank you, folks, as always, for watching and listening. Be back again soon. Take care. Bye-bye.